A Canadian superannuation fund, which was part of a failed attempt to buy toll road operator Transurban, is having another crack at the Australian market. Canada Pension Plan has offered $3.5 billion for Intoll, a company formed out of the breakup of Macquarie Infrastructure Group. Andrew Robertson reports.
Toll road operator Intoll owns 25% of Sydney's M7 Westlink motorway, as well as 30% of what's known as the 407 toll road in Toronto in Canada. They're the better assets from the former Macquarie Infrastructure Group. For Intoll shareholder Rare Infrastructure, it's no surprise the company is now sought after.
The assets of Intoll are very good assets. They're cash-generating assets. They've got very long-term duration assets. The 407 is probably the most attractive toll road in the world.
The conditional Canada Pension Plan offer is for $1.19 in Canadian currency plus 23 Australian cents per Intoll stapled security. At a Canada-Australia exchange rate of 91 cents, it values Intoll at $1.54 Australian per security. Intoll security holders will be offered a choice of either cash or scrip or both. It's a premium of around 40%, but nonetheless a price which has divided the investment community.
It is in the ballpark. Their initial offer on Transurban, in our view, was not in the ballpark. And so perhaps they learnt that lesson that if you do start off too low, then you might miss out.
However, Elio D'Amato from Lincoln Intelligent Share Market Solutions is not convinced Canada Pension Plan's offer represents good value.
This is quite a nice little premium that's being applied to the stock, but that said, though, it's still, picking up a good longer-term asset at a very reasonable price.
Intoll directors say they've not formed a view as to the adequacy of the proposal and accordingly recommend that Intoll security holders take no action at this time. It's a position Rare Infrastructure's Richard Elmsley is happy to adhere to for now.
We think it's attractive. So they're doing some due diligence in the next 3 weeks. Maybe they'll firm their offer up a bit. It would be attractive to them because they can eliminate management costs immediately, which we estimate is about 15 cents a share.
Intoll securities leapt more than 30% in response to the takeover, peaking at $1.47, 7 cents less than the bid price, which according to Austock's Andrew Chambers means the market sees some risks in the deal.
There are a number of conditions attached, and they'll obviously need to work through those. There is a little bit of currency risk as well because the bid does move with the currency.
Because of Intoll's size, Canada Pension Plan will need approval for its takeover from the Foreign Investment Review Board. The irony of that is that 90% of Intoll's value is contained in its holding in the Toronto toll road. And that, in effect, means a Canadian institution will be asking permission from the Australian government to buy a Canadian asset. The reality is that for many security holders who received their Intoll stock in the breakup of Macquarie Infrastructure, their investment is well underwater. For that reason, Lincoln's Elio D'Amato says small investors in particular should see the offer as a chance to salvage some value.
These types of investments traditionally are, quite volatile. They can also be quite complex when it comes to recording for tax purposes. So we think that this indicative offer is something that mum and dad investors should probably take up. If not, just sell on market now in order to realise the profit quickly.
Canada Pension Plan has 3 weeks to conduct exclusive due diligence, and in that time, directors of Intoll will try to reach agreement on a takeover deal they can recommend to security holders.